Right now, as we speak, Applied Digital Corporation, ticker symbol APLD, is trading live at $21.28. The intraday action has been nothing short of a battlefield, swinging aggressively between a low of $19.01 and a high of $21.93. We are looking at a stock that is currently down roughly 1.3% from the previous close, yet the volume is surging, with over 36 million shares changing hands already, against an average of 30 million. If you are watching the order book, you can see the tug-of-war happening in real time. The bid-ask spread is tightening, and the volatility is palpable. This isn't just a red day or a green day. This is a repricing event happening before our eyes. Most investors looking at this chart see a former crypto miner struggling to find its footing in a volatile tech sector. They see the debt figures, they see the recent dip from the $40 highs, and they assume this is a wait-and-see story. That is the expectation. A high-risk, capital-intensive play that might run out of cash before it builds its infrastructure. But here is the reality that the headline skimmers are missing. Applied Digital is no longer just a crypto proxy. It has successfully secured the one asset that companies like Microsoft, Google, and the holders of Nvidia stock are desperate for: power. While the market frets over the recent $2.35 billion debt offering, the smart money realizes that this financing wasn't a lifeline. It was a war chest. This company isn't struggling to survive. It is fully funded to build out a pipeline that could make it one of the most critical landlords in the artificial intelligence ecosystem. When you look at the sheer violence of today's price action, you have to understand the psychological backdrop. Retail traders using apps like Robinhood or SoFi Invest are often reacting to the surface-level noise, the debt headlines, or the daily percentage drop. They see a double-digit drawdown over the last week and they panic sell. However, if you look at the institutional flows, the activity you would typically see coming through desks at Goldman Sachs or routed through interactive brokers, you see accumulation. The price of $21.28 is acting as a massive psychological pivot point. The bears are trying to push it below the $20 support level we tested earlier today at $19.01. But every time it dips that low, a massive wall of buy orders steps in. This tells us that the smart money has identified the heavily discounted valuation relative to the sheer gigawatt-scale capacity this company controls. Let's talk about that capacity, because that is where the tension between expectation and reality truly snaps. The common narrative on investing sites is that we are in an AI bubble and that infrastructure plays are overextended. You might hear this from skeptical friends or read it in bearish subreddits, but the reality on the ground in North Dakota, where Applied Digital operates, is entirely different. We are facing a global shortage of power-ready data center capacity. You can buy all the Nvidia chips you want, but if you cannot plug them in, they are effectively paperweights. Applied Digital has secured power. They have the transformers, they have the land, and most importantly, they have the interconnect approvals. This is why the stock is holding the $21 line despite the broader market pressure. They possess the utilities of the future economy. Consider the recent financing news that caused so much volatility. The company priced a private offering of over $2 billion in senior secured notes. When a retail investor on a Fidelity mobile app sees billions in debt, they often flinch. They think of interest payments and default risks. But you have to look deeper. This capital is project financing. It is specifically earmarked to build out the high-performance computing campuses that are already leased or in high demand. This is not debt taken to pay the electric bill. This is debt taken to build a factory that has customers lining up at the door. It is similar to how Tesla stock was viewed during the Model 3 ramp-up, terrifying cash burn to the uninitiated, but necessary capital expenditure to the visionary. The market is currently punishing APLD for doing exactly what it needs to do to become a giant. This brings us to the operational shift that makes this stock so fascinating right now. A few years ago, this was Applied Blockchain. The business model was simple. Plug in ASICs, mine Bitcoin, sell Bitcoin. It was a commodity business tied to the price of crypto assets. If you are still analyzing APLD as a crypto stock, you're looking at the wrong movie. The company has aggressively pivoted to HPC, high-performance computing. These are the data centers designed not for SHA-256 hashing, but for training large language models and running complex simulations. This requires different cooling, different rack density, and different redundancy levels. The fact that they have secured a major lease with a hyperscaler, widely rumored and discussed in analyst circles, validates that their infrastructure meets the rigorous standards of the Magnificent Seven tech giants. We need to discuss the specific mechanics of this trade for those of you managing your own portfolios, perhaps through Schwab Intelligent Portfolios or a self-directed account. The stock has a high short interest. This creates a coiled spring effect. When positive news hits, say a specific announcement of a new customer or the completion of the Ellendale facility, the shorts have to cover. We saw a glimpse of this when the stock touched $40 earlier this year. The current pullback to the $21 level essentially resets the risk-reward ratio. You are no longer buying the top, you are buying the consolidation. However, you must have the stomach for volatility. This is not a stock for the faint of heart or for funds you need next week. This is a play on the 3 to 5 year horizon of AI infrastructure build-out. Let's pause for a second. I want to hear from you. Comment below with your average cost basis on APLD if you are already in or if you are waiting for a specific price target to enter. Do you think the debt load is a deal breaker, or is it just the cost of doing business in the data center world? Now, back to the analysis. We have to look at the competitive landscape. You have companies like CoreWeave, which is private, but massive. And you have the traditional REITs like Equinix or Digital Realty. The traditional REITs are safe, steady, dividend-paying stocks you might find in a conservative Fidelity mutual fund. But they are also slow. They have legacy infrastructure that isn't always suited for the density of modern AI clusters, which generate tremendous heat. Applied Digital is building fresh. They are building born-for-AI facilities. This gives them a technological edge. Their sail designs and liquid cooling capabilities are specifically engineered for the H100 and impending Blackwell chips from Nvidia. When you invest in APLD, you are betting that the legacy providers can't retrofit fast enough to catch the wave that Applied Digital is already surfing. We need to address the institutional ownership structure because it provides a safety net that isn't immediately visible on a simple line chart. Major players like BlackRock and Vanguard have significant stakes here. They're not day trading on the Robinhood app. They are holding for the long term. Their presence suggests that the due diligence on the debt structuring and the power contracts has been done. Furthermore, the company's management has significant skin in the game. Insider ownership is a key metric I always look for in small to mid-cap growth stocks. If the CEO is selling, I'm worried. In this case, we have seen a management team that is aggressively expanding, signaling their belief that the share price is currently undervalued relative to the company's future cash flows. Let's dissect the online investment angle a bit more. In the current market environment, retail investors are empowered like never before. You have access to the same filings and the same charts as the pros. However, the interpretation of that data is where the edge lies. When you see a headline about dilution or debt offering, the algorithmic trading bots often react instantly, driving the price down. We saw that with APLD recently. But if you are using a platform like Interactive Brokers or checking the depth of market, you often see that the drop is on low volume or that it is quickly absorbed. This divergence between price and value is your opportunity. The online investing crowd often chases momentum. They buy when it's going up and sell when it's going down. To make money in a stock like APLD, you often have to do the opposite. Buy when the narrative is muddy and sell when the clarity returns and the premium is priced in. The relationship with Nvidia is another cornerstone of the bullish thesis. Nvidia has previously participated in financing for Applied Digital. This is not just a financial transaction. It is a stamp of approval. It signals that the hardware manufacturer trusts the infrastructure provider to host its precious silicon. In a world where supply chain constraints are the primary bottleneck, having a direct line to the kingmaker of the AI industry is an intangible asset that doesn't show up on the balance sheet but matters immensely for the stock's long-term multiple. If you hold Nvidia stock, APLD is a natural hedge or companion play. It is the picks and shovels to Nvidia's gold. Now let's look at the risks, because a professional analysis is worthless without acknowledging the downside.